Hi, I'm Ross from Kerr Smith 150 Group Property Accountants, and we're just going to go through, yes, a couple of little examples today, just looking at how much has things changed with interest rates going up, a little bit about new builds, and a little bit of a twist or an opportunity there a little bit. And the main thing to really take away from today is just, make sure you actually know and understand your numbers. Make sure you know what they're going to look like over the next 5 or 10 years. Make sure you know what these tax changes are going to do to your numbers, and really sort of understand these a little bit. So hopefully this will help a little bit. So I'm going to look at the same property. I'm going to look at if it's existing, which it actually is. What do the numbers look like? If it was a new property or social housing, what would the numbers look like? And if it was new with interest rate specials, what would it look like? So 3 different things. And just to start off, what I'm looking at is, I always look at 100% debt. And this seems to be a common issue, or just a way of looking at things. To me, you're buying a property for $1 million, you've got 500,000 cash. Look at the numbers with $1 million debt. Look, how good is this rental? Does it really make sense? Because you've obviously got an opportunity cost of bringing in that 500,000. It could be sitting in other funds or used for other things and getting a return there. So it's not free money. You still need a return on that money. And especially if you've got an existing property, you bought it for 200,000 years ago. It's now worth $1 million. Look at the numbers at $1 million and a full debt of $1 million, and look at how do they actually look. Because obviously you could sell that property, get out the $800,000 and do something else with that. So there's an opportunity cost. So kind of look at it like, if you sold it and purchased again, how would it compare with other opportunities? And that's your best way of comparing. So always look at 100% debt on the fair market value, not on what you bought the property for. Because often you'll find is that you've had a really good property, it's done extremely well, but it doesn't mean that it's still working for you, and maybe a different option could be a whole lot better. So if you do have an existing rental, great question to ask yourself is, if you did already own it, would you buy it again as a rental property at the full fair market value? So the one that you bought for 200,000 years ago, now worth $1 million, would you actually buy that property for $1 million today as a rental? And if you're thinking no, it means you kind of got to review what you already have and check that actually is working for you. So all these examples are obviously 100% debt. So this is an example, just one that came up in my Facebook feeds recently. It's a Frankton property in Hamilton. Frankton's an average sort of area in Hamilton, but relatively close to the central business district. This one, obviously 699,000, 2 bedroom, 2 bathrooms, 2 toilets, 1 car park. It's pretty much your stock standard sort of townhouse, lots of these duplexes or townhouses around. Rent, when I sort of looked around, they seem to be going for about 485, and this one's actually a 2017 build. But there's a lot of new 2 bedrooms come out in Frankton recently, so there's a lot of competition. So it can be a bit hard to rent them at the moment. But you're sort of looking, that's your basic townhouse. It's got 2 bathrooms, so maybe a little bit more than others. If we then look at the numbers, oops, slightly on the wrong spreadsheet. So our numbers, it's 699,000. Obviously, you've got a few costs. There's going to be some legal fees. You might set up a company. You might get a valuation, things like that. It might be a building inspection. Normally, you'll get some sort of contribution from the bank. And just to bear in mind, there are those extra costs. You need to look at, how likely is this property to be rented for 52 weeks? This property is in a reasonable location. So I've worked on 52 weeks, but if you've got a bad location, bad property, you'll need to work on less. Or if it's rent by room, you generally get more vacancy. So this one, 52 times 485, 25,000. 25,000 divided by 699 is 3.6% gross yield. To me, that's not great. It's not going to give us a great number, but it is where a lot of areas are sitting. Hamilton, Tauranga are sitting below 4%. Auckland, you're probably low 3%. Even like Christchurch used to be in the 5s, and now it's probably below 4% or around 4% as well. So we'd love to get more, but it is getting harder to do that. Then I've got all the expenses. So this will have some sort of body corporate residence association, some sort of shared costs, plus some insurance. Interest rate at the moment, about 3.6 for 1 year. And obviously that's jumped up hugely from recently. Property management rates, relatively new 2017, so low repairs, some education, maybe you join Waikato Property Investors or Auckland Property Investors or your local Property Investors Association. A little bit of travel, obviously if you were in the South Island, you'd add in some more. So we've got 25,000 of income, 35,000 going out, you're losing 10,000 a year. So that is obviously a big cash cost. Just for curiosity, if we put 2.19, which interest rates were not long ago, that would drop 10,000 off our interest and basically break even. So interesting how much that's changed with interest rates over the last 6 or 9 months. Generally, you would get depreciation. It's still relatively new, so you'd get value it in, get chattels depreciation done, depreciate your carpets, curtains, dishwasher, stove, heat pumps, and other chattels. So in the past, that would give you a big loss. No tax to pay because it's a loss, and ring fencing would come in. You can't offset that against your other income, but you can offset it against other property income. So that was all looking great, but obviously the new tax changes have come in for this. It's an existing property. So yeah, say you bought this today, it's after the 1st of October 21, so you can't claim interest. So you can't claim that 25,000, you're down to 0 interest deduction. So from a tax point of view, 25,000 in, 10 out, you're making 15,000 taxable profit, less depreciation, you've still got 10,000 taxable profit left. So in the past, paying 0 tax, now we're paying 3.5. So this property is really costing you 10 grand. You're paying 3.5 in tax, costing $14,000. That is the first year at 3.6%. That is interest only. So yeah, and it's $268 a week. If we went P&I, your $27,000 a year you'd have to put into this property every year over the next 30 years, and that's still based on our 3.6% for the first year. So obviously the expectation seems to be interest rates will go up at the moment, so we'd expect that loss to get higher and higher. So that's pretty hideous, really. If we look at exactly the same property as a new build, so yeah, 699,000, same rent, same expenses, same loss. We've got slightly lower repairs because a new build, you might be doing some heat pump servicing and yeah, and just a wash or something like that, but you'll have slightly lower repairs. The other one was only 4 years old, so not a lot either. We've also got higher depreciation, and the good thing about this is it's a new build, so we get to keep the interest deduction. We don't have to go over to the side and pay higher tax. Yeah, we've got a loss for tax purposes. We're paying no tax, but we're still losing $10,000, and that's at the 3.6% interest rate. So yeah, first year losing 10,000. If we went P&I, like I say, it's not that bottom one. We can put a big line through that. It won't be this one. But yeah, we're still looking at $23,000 you'd have to put in per year if you wanted to go P&I. So those are huge losses. That's the first year. So obviously what we're then thinking is over time, interest rates are likely to go up. So looking at the next 10 years and trying to estimate what's going to happen, rent go up, interest rates going to go up. I've been a bit conservative, half 1 year, half 5 years, interest rates going from 3.6 to 5.5 over 10 years. Existing property, I've got it an average over those 10 years losing $22,000. Interest only, ouch. But a new build, it's a little bit better. About $4,000 a year better, but it's still losing $18,000 on average per year over the next 10 years. So both of these really sucking your cash flow. And yeah, it's going to be really hard for you to buy more and more properties and get ahead because you're putting so much into these. So yeah, over, like, if we look at one of these, if we just look at the new build, you're looking at a 10-year cost estimated to be 183,000, and you're hoping it's going to go up 531,000, and that's just based on 6.3% history. Obviously, none of us know what's going to happen in the future. We don't know how much property is going to go up, but based on the past, it would have gone up 531,000 in the next 10 years. So you're really gambling on capital gains, 183,000 and 18,000 per year, hoping it'll go up 500. So that equation can work still, but it is putting a lot of pressure on you with a lot of money in. And like I said, that is interest only. If you had to go P&I, that is going to be very hard. So yeah, looking at those numbers again, they're all interest only, average per year over the next 10 years. We're expecting 22,000 loss per year on the existing, 18,000 per loss on the new build, or if you times them by 10, 220,000 loss on the existing over 10 years, 180,000 loss on the new build. So yeah, those numbers are not looking great, and it's really showing that buying a stock standard, new or existing, really don't work, and you need to be a bit more creative. One option is back my build. So say it's 2.15%, and I'll give you a little bit more information about it in a second. What do you think then? So we'll grab across my spreadsheet, and obviously, yeah, a whole lot better interest rate. So same numbers, same things, yeah, 2.15%. Basically at break even to start with. We still get a chattel's loss, which is a book entry. It's not 6,000 you're actually paying out in cash. It's more of a book entry, so you're ending up with a loss for tax purposes. Obviously your chattels, do bear in mind at some point you do have to replace them, but your property still goes up in value normally, so it's often not really a real cash cost. This one making you $1.32 in the first year. If we look over the first few years, these are my overall cash per year. So first year dollar positive, then 453, then 918. So you're making 1,400 over the first 3 years with that low interest rate if it stayed down, and then looking at big cash losses once you go up on higher interest rates. Yeah, so interesting to see. So what we're looking at, that again, average over the next 10 years, we're looking 13,000 loss, or 134,000 over those 10 years. So yeah, back my build. Generally it's 3 years. It's ASB or ANZ. It's floating, so there's obvious risks that that could go up. First 3 years, it was slightly positive on interest only. And yeah, overall 10 years, average loss 13,000, and that's interest only, the same as the other ones. So if we're comparing all those three properties, yeah, we've got 22,000 loss, we've got 18,000 loss, and yeah, we've got 13,000 loss for the back my build, average per year. So yeah, over 10 years, basically 10 times all those figures. So yeah, be very careful out there. Make sure you have a good look before you buy a property. What is it costing you? What's it going to cost you over the next 10 years? How do these new rules affect it? And if you've got existing rentals, looking at them as well, what do these numbers look like now if interest rates changing so much? What do the new tax changes do? And often it's worth just going through this. And it's not necessarily that you're going to sell a property losing money, but it's about reviewing it in your overall situation. If you had really bad cash flow, you wouldn't want a property costing you 22,000 per year. If you've got really good cash flow, some more options, or if you've got some good, some bad, so that overall mix of the portfolio can really help. So hopefully you've enjoyed that. Hopefully it's given you some information. And yeah, I've got another video that I'll be recording probably tomorrow. Yeah, so watch out for that in the next few days as well. Thanks a lot. Bye.